what we're seeing, again, are very large non-compliance rates. The IRS has cited up to a 75% non-compliance rate. So the majority of these transactions up to this point are not being reported properly. And as the market becomes more and more relevant and continues to grow more, this just isn't sustainable, and the level of non-compliance makes this third-party reporting inevitable for digital assets. So we've reached a turning point, as I mentioned. Many of you may have received your 1099 DA this week, or you may be in the future. And what the 1099 DA is a new IRS information reporting form that requires digital asset brokers to report the transactions directly to the IRS. So for 2025, it's mainly going to be reporting proceeds data. And then as we go into subsequent years for covered assets, it's going to also be reporting cost basis data, although there may be gaps in this, which we'll discuss. The big takeaway here is that the IRS now receives transaction data independent of what the taxpayer is reporting, and they're going to be able to now match this independently sourced data to what the taxpayer is reporting and put it into the tax systems, including the automated matching system, which will allow them to detect discrepancies much more quickly and much more systematically. So why is I don't know what's wrong with that slide there, sorry. What are some of the challenges with tax reporting for digital assets? You're dealing with 3 sets of records that all are not designed to reconcile properly. You start with your on-chain transactions and your exchange records, which are not standardized, and then you have to calculate these in a tax software that has divergent treatment depending on the tax software you use, the protocols you're interacting with, and what your overall activity looks like on chain. And now these 2 systems have to now reconcile on your tax return to what's being reported on Form 1099 DA. So what I'm anticipating are, some implementation challenges.